This is Creator Finance, the only financial planning podcast built for creators by a creator. Here's what most financial advisors will tell you. Get a proper job with a steady income. Here's what I'll tell you. Being a creator or digital entrepreneur could make you wealthier than any 9 to 5, if you know what you're doing with your money. My name's George Agan, I'm a creator and chartered financial planner, and this is where creative freedom meets financial freedom. So, welcome to the first solo show of Creator Finance. I just want to talk first about why I'm doing these solo shows. And I think the reason why is, well, apart from the fact that it's way easier to do a solo show as far as production, but I also realized when I reflected back on my older conversations with guests is it was incredibly useful to have people come in to talk through the things that were impacting them, whether they're an expert in their field, like Kush, who was an incredible solicitor, or whether they're creating themselves, like the episode I had with Damien or Ollie's. But ultimately, what we're not getting through that, if we're just doing those episodes, is we're not getting any kind of education around the key things that are going to make you good with money going forward. And that's one of the key objectives of Creator Finance. I want to use this platform to make sure you have the tools to equip yourself to be good with money. All it really takes is one person in a family who really understands money to have potentially an intergenerational impact. But to begin with, you have to be engaged to an extent. Money's like your health. You can ignore it, you can maybe outsource it to a degree, but ultimately you have to have a degree of understanding if you're ever going to master it, and it's a lifelong skill. So the way that I've structured these episodes is I've set them into kind of 3 core components, and I'll just talk about why I've done this and the thinking behind it. The first bit is markets. We're just going to give you a quick update in relation to a few market topics. That might be performance, that might be events that are happening in the market. It might be things like inflation, it might be things that are happening around budgets. I want to do that because it keeps the show relevant. It means that if you listen to it, you're getting something that is timely, that gives you something to talk about perhaps and something to think about. And I like having that informative angle. Some of the podcasts that I enjoy the most have that informative angle. The next bit is going to be like a core education topic. So that's going to be the key creator finance topic. So today I'm going to be going over pension essentials. Bear with me, this is important. You do want to watch this bit. And I want to talk about why they're misunderstood, how they can be an incredible tool, when to use them, when to not, the mistakes that entrepreneurs and creators make with their pensions. It's an intro. So I wanted it to first give you a blueprint on where you are in your creator journey and basically act as, because of my experience within financial planning and wealth management, I can see the predictable steps that people take on their journey to building wealth. And for entrepreneurs and for creators, I think there is a well-trodden path. So whether you're maybe earning your first 50,000, 100,000 or million, it's just useful to have a look at, okay, where am I on the creator journey? Where could I potentially go? Where do I want to stop? And what then are going to be the key financial planning things that a creator would consider at that level? So that's a link in the description. I've also got £10,000 of tax saving tips, which is basically to act like a bit of a checklist for your accountant. So here I'm assuming that you've got a limited company, and what this is, it goes into loads of little tax saving tips that you can potentially use. Some accountants are amazing and maybe you'll be already enacting all of them. Maybe you're not, and you can use that to spark off a conversation and hopefully save a little bit of money. So the creative finance topic today is going to be more a foundational topic on pensions. I'll be diving into things like this in more and more detail in later episodes. And the last bit is the best story that I've ever been given on storytelling. And it's directly relevant whether you're an entrepreneur or a creator, because if you ever create anything, whether you're an artist, whether you've got your own channel, we are storytelling machines. And I think it's always good to reflect on what makes a good story and the things that we should be considering. It's certainly the one which has really resonated with me the most and what I think about on my journey. So let's go into markets.
My question is, how do you time the big market moves so well?
We haven't the faintest idea what the stock market is going to do or timed anything.
So I want to address 3 key bits in the markets update today. I want to go over performance, a bit of a look back on 2025. I want to talk about inflation and then wrap up with a bit of a primer on valuations and what that means going forward. So what happened in 2025? Well, at time of recording, it was a bumper year in the markets. In fact, it has been a bumper year across major markets globally. The S&P 500, that is the 500 biggest companies in the US stock market, that was up over the year about 16.9%. The exact performance varies on a daily basis. So depending on whether you're measuring it today or whatever, doesn't really matter. 16.9% is a really strong return. Interestingly, though, the FTSE 100, which is the UK market, that's the 100 biggest companies in the UK stock exchange, or the London Stock Exchange, was 20.47. Now, one of the reasons people talk about that is because while everyone thinks that it's the tech titans that are running away with it, the UK, after having quite a few years of underperforming the US market, seems to have turned a bit of a corner. But the lesson from this is if you look at an all-cap index, so basically a global index, that's up 21%. You'll see slight variations depending on what index you measure, but a good lesson again that you can never really predict what individual market is going to have a bumper year. And if you're looking for increasing your probability of getting a good outcome, the best way to be is often global, as in globally diversified, because you just don't know. You don't know whether, a particular geography, a particular market is going to do really well or terribly. At the time of recording, we've got Trump basically invading Venezuela. You didn't want to be all in on the Venezuelan market. Not that I think you would be anyway. And likewise in markets all across the world, one of the things when you have a look at the historical data that really surprises people is everyone just thinks automatically that the US was the best performing market the last 50 years. That isn't the case. It was the Australian market, I think, last time I checked. So you've got, we have these biases that we all hold. And the simplest way to get around this often is just to go, actually, I'm going to hold my hands up and say, I don't know what particular market's going to outperform, and therefore I'm going to focus on what I do know. And while there are no guarantees ever with investing, one thing that I am absolutely certain of is that people are going to buy and sell things from each other on a daily basis. There is going to be an incentive for people to go out and make money, and that's going to continue to happen all over the world in varying degrees. With that in mind, if that is my philosophy, which it is, then how can I align my financial future in the best way to that? And the best way, I believe, is generally looking at globally diversified being the core. And yeah, if you want to have a bit of a fun bucket where you take punts on certain stocks, certain markets, that's fine. I have this in my portfolio. I call it a money pit. You should call yours a money pit because you are setting fire to that money. Hopefully not setting fire to that money. But you got to look at it and go, right, I'm making a speculative bet here. Maybe it'll do really well. I hope it does. But crucially, is my financial fortress good enough if that doesn't happen? Do I have the capacity to take that risk in those areas? Am I going to look back in 10, 20 years and go, I'm still financially secure regardless of whether these bets took off or not? And the best way to do that, in my personal opinion, is to align yourself to a globally diversified portfolio. So 2025, great year in the markets. My last point just on that performance bit is, I don't know how closely all of you followed it, but in April 2025, we had the so-called Trump slump. Trump came out, I'm sure you saw it on news notifications, held a big board up saying that there was going to be tariffs, the highest tariffs in the US since the 1930s. The market correctly thought this would be quite a shock. Trump had run his election on that he was going to do tariffs, but the scale and the scope of them were unexpected, and the market took a huge dive. Now, that, if logically, would make a lot of sense. There's going to be huge tariff that's going to dampen the economy. It's going to create a huge headwind for trade. Why would the markets not pull back? Now, then if I was to kind of look towards the end of the year and say, well, actually, this is going to be one of the best years in the markets for some time, I don't think you would have believed me. And the things that followed that was, well, there was lots of exemptions under the tariffs. The phrase, the taco trade was coined, which stands for Trump always chickens out. AI continued to deliver fantastic results for the kind of the big tech companies, which drove the global markets. And the catastrophizing, you could say, or maybe even the logical concern around the impact on goods that the tariffs would create just didn't materialize. It reminds me a lot of what happened in 2020. When we went into the global pandemic, there was every logical reason to sell your stocks and think we're going to head into the new depression. We literally stopped people going outside, but yet the markets generally were flat at the end of that year. If you'd bought into the dip, you would have done very well in 2020. And while, because of regulation, I'm required to say the past performance doesn't reliably show the future, just because that happened before doesn't mean it'll happen again. What I can say is that you just can't predict these things. And that's certainly how I manage things with my clients and how I manage my own money. So let's go into one of the kind of the key themes that is going to be driving markets. And I think is going to be the theme of this decade, which is around inflation. Inflation at the moment globally is coming down from its 2020 to 2023 kind of heights where it peaked, depending on what inflation measure you're looking at, because they all differ slightly. And that's maybe a topic for another video. Globally, inflation over a single year period was 7-8%. At certain points, it peaked above 10 and then dropped down. We had 2 years of really structurally high inflation. And one of the kind of the misunderstandings sometimes with inflation is when inflation falls, things get cheaper. And that just simply is not the case. The way to think about it is imagine you've got a car accelerating at 60 miles an hour and it keeps accelerating away from you. And this is to represent inflation. If that car drops in speed, if it goes from 60 miles to 20 miles an hour, it's still going away from you. It's still going some distance. And you still have, depending on what your other assets have done, you still have a huge gap between where you were a couple of years ago to where you are, where the car is now. So what is the lesson here? Well, the lesson is that real wealth is inflation adjusted. This is crucial. Your wealth is not the money in your bank account. It is the money over time after adjusting for inflation. That pint of milk you buy today has to keep up in line with the value of the money you have, has to keep up in line with inflation over time. Otherwise, you're getting poorer and poorer. And while I would like to think the spikes in inflation we saw in 2020, 2023 were once every 10, 20, 30 years. Last time we saw something this strong was in the 70s. It will happen again. And people who had money left in bank accounts have been severely, severely hit as far as their wealth, their savings. The problem is when we go through these inflationary spikes, it gets embedded into the system. There are things called wage price spirals, which I don't think anyone globally has gone through yet. But it's a predictable pattern that happens again and again with inflation, which is that once prices rise, that gets embedded into the price of goods, and then the services then follow. Because understandably, if you're in a position where you were earning a certain amount and then everything's become more expensive, what's the first thing you're going to do in your work? You're going to say, right, I need to earn more money. You need to pay me more because the purchasing power I had a year or two ago isn't worth the same as today. Now, wages generally haven't managed to keep up in line with inflation, which is why the cost of living crisis has been so acute for so many people. But the key lesson, which I think is going to be the theme of this decade, or certainly from 2022, maybe till 2032, is we have gone from a low interest rate, low inflation environment, which we had since 2009, since the great financial crisis, to, I believe, being a stickier inflationary environment, what's called a stagflationary environment, where we have quite stagnant growth and more sticky inflation. What can we do to protect our finances in this environment? Well, we've got to look at every pound that we're earning and make sure that we align the money we have to our goals. So if you have long-term money, can you afford to keep it in cash and potentially be eroded by inflation? Yes, interest rates might match inflation for the moment, but over the long term, we have to be really mindful that inflation spikes again, interest rates might not keep up with that. When inflation spiked in 2022, banks didn't just overnight, ratchet up their interest rates. They took time. They made money on the spread while people were potentially getting poorer. And that's even if you can be bothered going through the hassle of constantly shifting from bank account to bank account. The big banks are dreadful generally as far as what they offer you on most interest rates. We're seeing inflation being more sticky in the UK. That is because of various factors. We have less energy independence, and I think that's going to continue, is my personal opinion. It's starting to come down. The market is pricing in that inflation is going to continue to drop slowly, but the 1% world is long gone. The 1% inflation, 1% interest rate world of 2020 and 2021, I think is gone forever. And maybe that's a good thing. So let's move on to valuations. So there are a ton of valuation measures, and I'm just going to talk about the forward price to earnings ratio. So what on earth is this? You might hear when people talk about stock valuations, they talk about price to earnings. And the way that I want you to think about this is, let's use an analogy using a buy-to-let house, because it's a buy-to-let investment, because it's the easiest, and regardless of where you are in your financial journey, it's going to be the easiest one to kind of grasp conceptually. So let's say you buy a buy-to-let property and it provides, £8,000 per year rent, and that's the yield that you get. Now, if you buy it in some terrible area and the value of that property is £100,000, that means you have an 8% yield before taxes and any other potential drag you've got. You've got 8% as a headline yield. Now, let's say that you don't want to be dealing with, potentially a bit of a nightmare area, harder, tenants to keep, paying rent and all the rest of it. Let's say you now then buy a property which is worth 200,000. Well, yes, your rent might go up, but let's just say in this example, you get the same yield. So what would happen then is that 8% yield would then drop to 4%. Basically, the price you have paid for the asset and the income, the earnings it produces, has a direct impact on the yield, the return you get. That's a very simplified example. Now, stock markets broadly work on the same way, but it's a bit more complicated with stock markets because you don't just have the earnings that are being priced into the stock. You have the growth expectations, you have the stability of the company, you have frankly a ton, sometimes how enigmatic the CEO is and the vision that it has for the future. Warren Buffett's famous phrase is that the market is over the short term a voting machine and is over the long term a weighing machine. And over the short term, because of speculation, the difference between the price that somebody can, or the market can put on a stock versus the underlying earnings can be huge. And Tesla are a great example. I don't have the stats immediately available, but last time I checked, in fact, let's check. Let's do this live and let's just use, I won't look at the forward P, I'll just look at the standard price to earnings. So as per Google Markets, again, I've not double checked this, but it's saying the price to earnings of Tesla at the moment is sitting at 334, which means that when you buy a Tesla share, the underlying earnings, what Tesla makes, is basically the price is 334 times the dollar of earnings you're buying. So let's just take that in for a second. That basically means that if Tesla was just earning $1, you would have to wait 334 years if it remained doing the same thing every single year for you to get your money back, for you to get your capital that you put in back. Now, how can this happen? Well, it's because it's not just the underlying earnings that people are buying it. And Tesla's a really exaggerated example because it is a bit of a meme stock, is the truth. It has Elon Musk, who is enigmatic, whatever you think about him. He is a genius, I believe, whatever you think about him. And there is a lot of growth expectation built in. People that hold Tesla shares, they believe that whether it's going to be robo-taxis or whether it's going to be, what's the next thing? Is he doing those bots, isn't he? Those robots. They truly believe in the narrative. And that means that people are willing to pay a lot for each pound or dollar of underlying earnings. So I've talked now about the price to earnings and how it is a good metric, but ultimately long term, over the very, very long term, what you pay for an investment does impact versus its earnings does impact the return you're going to get. That doesn't mean that that's exactly the return you're going to get. It's not a science, because you might happen to pick a company where it's not earning that much, but the growth actually materializes. If you were to think about a company like Nvidia, if you were to go back 5 years ago, most people would think about it as the company that makes chips for things like PlayStation. That's when they were starting to get into AI. You wouldn't have predicted the just insane growth that they would have then achieved thereafter. So where I'm going with this is just to say that valuations are gravity in finance. That doesn't mean that gravity acts immediately. Valuations can be high for a very long time. Sometimes higher valuations are justified. But when you're considering an investment, in the same way you would if you were to buy a buy-to-let property, you should be, whether this is your friend's business or whether this is the global markets, you should be aware of what valuations are, because it's certainly going to help you understand how pricey a market is and whether you're getting in at a point compared to history, which is valuations are higher or lower. Now, the challenge, and this is something I have conversations with clients daily, is that valuations compared to history are high everywhere, or certainly in most markets, apart from arguably in the UK and some other markets. So the US, at time of recording, let's have a look, forward price to earnings, so this is the forward expectations of earnings versus the price, is about 24 times. Now, the historical range, that would put that right at the top of its range. The top of its range historically is about 25 times. Globally, if we have a look at global markets, their price to earnings is about 20, and the top of the historical range is about 26. Valuations globally aren't as high as they are in the US. If we have a look at the UK, the top of its range is about 23, and it's currently trading at about 12. So when I was going back to the valuation position at the start, saying that the UK market has performed better than the S&P 500, which is the US market, it's because it's coming from a lower base. It's coming from a position where valuations were lower. And if we consider standard valuation theory, we would expect over the long term the UK market would outperform. Now, does that mean it will happen in reality? Well, no, because if the US continues to develop companies which continue to innovate in the way that they have and continue to be at the forefront of the technological revolutions, and we in the UK, this could be a different UK rant, but we aren't able to capture the fact that we invent most of these technologies, and we don't capture the value that often we create, then we're going to continue to be in a position where the valuation of the UK as a country is going to be depressed when we look at the London Stock Exchange. So that's where we're at with global markets. What can we do about it? Have a long-term focus. Valuations important. I think it's important for you to be informed. I think it's important for you to, when you're making any investment, to be able to hold a good conversation on it, to feel like you're coming in from a position of understanding. The truth is, and I can tell you this being a finance professional, not professor. Would I ever become a professor? No, I'm probably not good enough to do that. Anyway, let's move on. When we look at the long term, that's all that matters. What I can tell you, or certainly promise you, is that there will be significant pullbacks. Since the 1972, there have been about 8 bear markets. That's where the market goes down 20%, peak to trough. Equity markets, it's a feature, not a bug, that the markets are going to pull back. When you are buying the global stock market, when you get these years like we have just gone, you are getting a return because you're accepting some volatility. So when we see the inevitable downturns, which is a when, not an if, what you can't do is you can't be surprised. You have to make sure behaviorally that you can stick to your plan, that you can stick to your long-term focus, and make sure that long-term money can be long-term money. And this is where, when I'm planning for clients, this is so crucial. We have to give the money a purpose over time. If it's short-term money, fine, great, we make the best of it. If it's medium-term money, okay, well, maybe we do a blend, maybe we have a look at the overall structure. If it's long-term money, we go for growth. Or we should be going for growth ideally, as long as you can stomach it and you don't make an expensive mistake when the inevitable downturn comes. So that's markets. Let's go into the creative finance topic, which is going to be about pension essentials. Okay, hear me out here, because what I don't want to do is I do not want to come across as just one of those advisors who's like, throw everything into your pension, nothing else matters. What I want to do as part of this conversation is just explain potential benefit, try and get rid of some misconceptions around pensions, tell you, in my view, when they can be incredible and when you should steer clear. Basically trying to give you a bit of an unvarnished truth so that you can hopefully make your own decision. Now, because of endless government tinkering with the rules, there's only so much I can cover today, and it's not going to be able to be comprehensive, and it's not going to be able to tell you every little bit of every rule. So I've gone over the key rules that I think you need to be aware of from the starter. But in future episodes, we're going to dive into more advanced stuff. The pension is just a vehicle. It's just a savings account with strings attached. And that's what I want you to think about it. Yes, unfortunately, governments are going to continue to tweak the rules, but there is certainly on an online culture, there's this whole thing about, don't use your pension, always reinvest in your business. And the truth is, these people often are selling you something. And the bottom line is just a tool. It's kind of like if somebody were to say, right, okay, so, you're going to get in good health, but I don't want you to ever do any weights. And it's kind of like, okay, well, or maybe even, I don't want you to do any exercise. It's kind of like, well, this is such a key component. How could you say you're generally doing right for somebody without considering such a key component of health, well-being in general? Pensions are like that for personal finance. It is just a vehicle. There are times to use it, there are times to not. You need to understand the basis of it. But just to ignore one of the most tax-efficient wealth-building tools at your disposal because some internet guru is talking to you about, YOLO, buy my course, that is bollocks. So let's talk about when to use them, when to not, the key things you need to be aware of. And whether you set up a pension or whether you continue to fund yours is your choice. I'm just hopefully giving you a bit of an idea on how you can make this decision. So what are the tax benefits of a pension? So let's start with the downsides, actually. A bit of a glass half empty guy. The downside is that depending on your age, at the moment, you cannot access the money. At time recording, it's 55. It's going up to 57. If you're in your 20s and 30s, I think 60 is probably what is going to be as far as when you can access it. If you're like 30 or under 35, I think they keep moving up what's called the normal minimum pension age, which should be 10 years, decade earlier than state pension age. So the reason why I'm saying 60 is I think, unfortunately, for most kind of 30, 35-year-olds, they could be looking at a 70 state pension age. Now, what does that mean? Well, it just means that we have to make sure that when we're getting the tax benefits, that we plan for ourselves in the future in the same way as we do today. We don't advantage our future entirely over ourselves. Because it would be crazy to overfill your pension and then not have enough money to buy a house or not have enough money to fund a business. I am not one of those advisors who's just going to say throw everything into your pension. To the same extent, there is a narrative that I hear for people who are getting absolutely hammered from tax that I'm not going to fill my pension because I can't get access to it. And it's like, okay, that's fine. But you've just given away 45% of your income because you have decided not to use a tax-efficient vehicle. You weren't going to spend it. It's now sat in cash doing nothing. You could have put that aside for your future self, not noticed the difference, still had the money that you needed to do the main things you need to do to improve your life. And you basically just cut your nose off to spite your face. So I want to try and create some balance here. So what are the three kind of tax things you need to be aware of with pensions? Well, you get tax relief on contributions. Whether that's through your limited or through yourself as an individual, the tax relief you get differs, and I'm going to come on to that in a second. You get tax-free growth. If you put money into an ISA, an individual savings account, you have paid tax on that money. And then you put it into a savings account, and then that grows tax-free. But with pensions, you get tax relief. So you haven't paid tax on that money, or certainly on the majority of that money. And then it also grows tax-free. And the idea is when you come to retire, especially if you're a higher rate taxpayer now, or you would be if you took extra drawings out your company, you're likely to be a lower rate of tax when you come to retire. So the way to think about the tax codes, it's kind of like buckets or levels of buckets. Levels of buckets, let's do that again. I can explain that better. Imagine it's water filling up a bucket. And on the bucket, you've got different lines. You've got your personal savings allowance, starts at the bottom. That's £12,570 per year. So as the water fills up, that's tax-free. The £12,570 is tax-free. So basically, you manage to keep all of that money in that bucket because there's no tax. Now, as you go from 12,570 to 50,270, you'll notice there's a little hole in the bucket, unfortunately. And that hole is precisely big enough, I would hate to try and design this, so that 20% of the water going in goes out. And that represents the 20% income tax bucket. So as you earn more money, more water comes in. You've had your 12,500 that's filled up, 570 that's filled up, and now the rest of it, all the way up to 50,270, 20% starts pouring out, and that goes to the lovely HMRC, and that's the basic rate. Now, as you go further up the bucket, the hole, unfortunately, is going to get bigger now, and now instead of the 20% coming out, you've got a bigger hole, and 40% is coming out. This 40% represents the higher rate of income tax, and the higher rate of income tax is 50,270. I should be clear, this is for income tax rates, not dividend tax rates, which are slightly different. I'm not going to go into the different tax rates on this episode. We'll do it on another one. But this is just income tax, not dividend. And then that 40%, so you're now above, so let's say the water's filling up. You've got your 12,570 at 0% tax rate. You've got your up to 50,270, 20% is squirreling away, unfortunately, to the lovely HMRC. But you keep the 80, remember that. And it's a little bit different because national insurance. But again, simplified example. Now we're at the 50,270, we're at your higher rate. Now 40% is going to go out to the bucket, to HMRC. That's the 40% rate. One of the things just visually when we think about this bucket filling and more going out at the side is that one of the massive misconceptions with income tax rates is people think that once you get to the 40% rate, that's 40% on all of your income. That isn't the truth. That is, and maybe that might be a simple thing to say, but a lot of people do get that misunderstanding. It's marginal, which means, like the bucket example, the amount that goes out depends on how much you earn. So if you earn £10 above the higher rate, I should say, you'll only pay £4 on the 10 above the higher rate. The stuff below is unaffected. Now, when you get up to 100,000, there's this horrible tax trap called what's called the 60% tax rate. Where, do you remember I said that 70, there's no tax, that's your personal allowance. When you start earning over 100,000, unfortunately, they start then putting a hole in the bottom of the bucket, so that even that 12,500 starts to go away. So what that means is that when you earn over £100,000, you then start losing that personal allowance at the bottom. It's a stupid rule. They should get rid of it because, and I'll go into this in later episodes, it causes loads of horrible distortions in the tax system. Anyway, that's the 60% tax trap at this 100,000, and then the next actual official tax band is 45% at £125, 140, and then that would be the top of the bucket, and everything above that is at 45%. But isn't it weird that we've got kind of 0, 20, 40, 60, 45? Anyway, I'll move on to that. That was a bit of a dive into the tax treatment there. Hopefully that will have made things a little bit easier for you to understand. But the key thing to bear in mind is that if you're doing well, if you're earning good money, the income that you need to sustain your life at the moment might require more water coming into that bucket. You might need 60,000 after tax each year to sustain you. You might need the £5,000 a month or whatever it is at this moment, because you might have, a life to live and holidays and work and and kids maybe. But when you come to retire, maybe the kids might have left the home and you're not going to be, your expenses you incur while working might not be there and your mortgage might be cleared. So there's a load of reasons to think that your kind of the bucket, the water that you'll need in the bucket in retirement is going to be at a lower rate. And what does that mean going back to the pension? It comes back to tax arbitrage. Arbitrage is when you kind of take advantage of two things to get profit. You're getting tax relief potentially at 40% or 45% or maybe higher. And then when you come to retire, you might be at a much lower tax rate. So you get to bank the tax advantage difference. You also get 25% as a tax-free lump sum. So the tax-free lump sum is currently, the specific figure is 268,275, but if you want to just think about it as $250,000, then just think about it that way. Basically, that means that if you have, for example, a pension pot of £1 million, then you can, under current legislation, take £250,000 of that as tax-free lump sum. You don't have to take it all as one. You can take it, I've got many clients where we take little chunks each year to top up their income, and it means that their tax rate is way lower in retirement. So if we think about this as a tool, the real advantage is if you're willing to have long-term focus, then you're using one of the most tax-efficient vehicles that we have. There are also not very many vehicles out there for wealth building where you can get this level of tax efficiency in contributions, in saving money, basically growth, while it's being invested over many, many decades. And you're not thrown into things which are incredibly high risk. You can buy a globally diversified fund at a low cost within a pension. You're not necessarily having to invest in smaller, more riskier companies. You can do lots with your pension as well. And I'm not going to dive into this on this overview of the episode, but you can buy commercial property via your pension. You can maybe even buy a studio for filming. There's loads of things you can do. You have to be careful. You have to get the right advice. But it can be an incredible vehicle. So I just want you to, if you're going to decide not to put money into your pension, I respect that. That's your decision. But I would make the case that it's one of the best vehicles that you can use. And when I'm looking at building financial freedom for clients, when we're building cash flow plans, which are basically how we kind of project your future and make sure that you've got enough so that you have FU money. The first years I have to try and make sure I fill are the years at the end, because once I know that I've got security for you in later life, then every year I'm getting additional wealth, I'm bringing that forward. You're not truly financially free if I say you can retire at 40 and then I say you got to go back at work at 60. In fact, that would be pretty devastating because all your skills will have atrophied and, you're probably going to be doing a crap job when you come back. So hopefully that has given you some things to think about. Let's just go over at a high level, the difference between individual contributions from you versus contributions from your company. I'm going to assume so for both of these, you have an annual allowance potentially up to 60,000. High earners have to be a bit careful. So what's an annual allowance? An annual allowance is how much the government says each year that you can put into your pension and still receive tax relief. You can actually put whatever you want into your pension. However, you could put £1 million in, but you will only get tax relief up to the annual allowance. So what that would mean is that if you were to throw a ton into your pension, the government then would come after you for the additional tax relief that had potentially been applied. Pension providers would hate it. Many might even not allow the payments to go in. The 60,000 annual allowance is kind of the starting point that we need to think about. It's the most you can put in each year, but there is also what's called carry forward, which means that as long as you've had a pension in place, you can carry forward any unused allowance for the last 3 years. This is an important point. I actually had to create a client where we wanted to use that carry forward. The business had been doing really well and we wanted to start throwing quite significant money into the pension because they had surplus reserves in the business, which is a really tax efficient thing to do. They had no kind of like later life savings at all, but we couldn't use that carry forward. And the reason why we couldn't use that carry forward is though that they'd been signed up for a pension scheme, they'd never actually put any money in because they left the job before the job could do that. And because they hadn't set up a pension in earlier years, carry forward was not available to them. So my message to you is that if you are not engaged in pensions at all and you're UK and you're over 18, there could be a really solid argument to just throwing in £10 into a pension. You'd have to consider a provider where maybe they charge on a percentage basis so that you're not then incurring high plan fees. You don't want to throw £10 in and then them charge you £20 a month for fees. But there are plenty of providers out there can do that. But even if you're not looking to fund your pension substantially now, you're going to be banking that carry forward for when the good times ideally come, you can use it. So I talked about annual allowance, 60,000. Let's talk now about how tax relief is applied. This is going to be high level and it's not going to cover everything because I could do like a 45-minute on the different sources. So I'm going to address the two main topics. I'm going to address doing it yourself as a private individual or as a sole trader. And then this is going to be the one that I think is going to apply to most people listening. I'm going to then talk about the tax relief if it's going from your creator business. So I'm assuming here you're a director of a business and you have some control over contributing to your pension directly. So let's just do it from yourself first. So this is coming from you as an individual. You might be going, all right, well, how does the tax relief actually work? Well, the most private pensions operate on what's called a relief at source basis. So how does this work? Well, let's say that you want to put £10 into your pension. You would get 20% relief automatically. So to get £10, if that was your goal, you would pay in £8 and they would automatically apply 20%. So you get 20% automatically applied. So the key thing that a lot of people miss here is that let's say that you're earning the higher rates. So you're earning over 50,270. You'll go, okay, well, I'm due marginal rate relief. I'm due 40% relief. what happens if I only get 20% added in? Where's my other 20% gone? This catches millions of people out a year. You then have to claim back the additional rate relief via your self-assessment. The government have actually put in a link now that you can do this online via the Gov website. But you have to claim back the additional tax relief. And millions of people don't do this because they don't know. And it catches a ton of people out. So if you're making individual contributions, if you've been a high rate tax rate payer and you haven't claimed back your additional rate relief, you should really consider that. And Damien Talks Money has done a great video on this. I think I'll link it in the bottom because he goes over it in quite a bit of detail. But you then have to claim back via self-assessment the additional 20 to 25% relief. When you make individual contributions, there is something that not a lot of people understand called national insurance leakage, which sounds, maybe that sound a bit grim. Anyway, when you get paid, let's say you're getting paid from an employer, you pay employee national, you'll pay income tax at your marginal rate, so 20, 40%, depending on, going back to that bucket, how much of the bucket you're filling. But you'll also pay national insurance. And the national insurance you get charged as employers get charged, and then employees get charged as well, which is 8% on basic rate and then 2% on higher rate. So the downside of making individual contributions is let's say you've got money that you've putting into your pension. Unfortunately, you lose some of your national insurance that you've been charged on that. So it's not quite as tax efficient because you're not only paying income tax, but you're also losing some national insurance savings. This is why salary sacrifice, where you sacrificed a bit of your salary and then it went into the pension. This is why that has been such a game changer for so many people, because that actually saves national insurance. Again, maybe a topic for another video. So we talked about individual contributions where you get 20% relief automatically. It's capped at £60,000 of your annual allowance, and you can potentially claim back an additional 20% or maybe 25% tax relief if you're, say, a 45% taxpayer. Let's now talk about the one which is going to apply for most people, which is going to be probably limited company pension contributions. So here, there is a fundamental rule you need to understand called wholly and exclusively. I could link HMRC's details here. It's not going to help you. Wholly and exclusively, in my view, is HMRC saying don't take the mick. And what they say is if you're going to put money into a pension for, say, a director, it has to be justifiably wholly and exclusively for the business. You can't just make massive pension contributions if it's not a legitimate business deduction. And what do I mean? What are they trying to catch out here? The truth is, what they're trying to catch out is somebody putting a ton into one of the directors' pensions, perhaps, when the value they're delivering to the business is not proportionate to that. So let's say that you are working with your spouse, and let's say that you are just shuffling some papers and your spouse is, you're both directors, and your spouse is maybe the one who's driving all the business. They have the skill set. And you rock up a day a week and you kind of like shuffle some papers. If you then, at the end of the tax year, both put in £60,000 into each of your pensions, HMRC could argue that is not, the contribution for you is not wholly and exclusively in line with the business, because ultimately you're maybe rocking up one day a week, not adding that much value, and you're getting a massive remuneration from the scheme year. Basically, the company's paying you a ton, and pensions are remuneration. That was one of the key things. It's called deferred pay, basically pay you're going to get later. It's one of the key reasons for how they equalise kind of sex equality, is that they kind of had a look at one of the judgments and they said, well, pensions are just deferred pay. It's just, you are just getting that pay, which is going to come to you later. So the thing you need to be aware of there is that if you do have slightly unequal treatment in the business, you need to be a bit mindful and speak with your accountant about how this is going to apply. I have had a lot of experience with this in speaking with accountants, and you will occasionally get an accountant where they just freak out about pensions and they get really nervous about it because it's not really their kind of area of expertise often. Generally speaking, for directors, as long as it's reasonable, you should be able to put in quite a bit into your pensions. Speak with your accountant about it. When I plan with clients, I often start the dialogue with the accountant and say, look, this is what I want to do as part of the planning. Can I just check that this is okay with you as far as business surpluses and as far as your planning? 99% of the time it's totally fine, but I would strongly suggest you check with your accountant if you're looking to make contributions. So let's go back to why this is so powerful through the limited company. The limited company can then deduct the pension contributions typically from corporation tax. So your corporation tax, depending on the size of your business, may be 19, 20, or 25%. There's no national insurance because it's gone directly from the business. So the business makes the payment into your pension and you pay no income tax. So if you think about what's happened there, it's one of the most effective ways to transfer wealth from your creative business, your whatever you're doing, maybe you're a digital entrepreneur, to your long-term savings vehicle. You are limited on how much you can put in each year to 60,000. However, you may have carry forward. If you've had a bumper year, you might be able to use some of your carry forward if you've been a pension scheme member in the last 3 years and you haven't used the previous years. So as far as kind of transferring wealth, it's hugely tax efficient because it's a deductible corporation tax expense. You can do both private and employer contributions, even though that's pretty rare for most entrepreneurs. They're typically going to mainly use contributions from the pension. The thing you need to be watching out for, and I've had this through clients, and I think this is definitely important to you if you're a creator who's not running a limited company, is there is what's called the tapered annual allowance. So let's say you're smashing it, you're bringing in a ton of money, you're bringing in 300,000 plus a year. If you then put in £60,000, you're going in for a shock potentially, because there is this thing called the tapered annual allowance. And at a high level, I just want to explain it. Why do we have the tapered annual allowance? It's kind of for high earners, footballers, celebrities, people who are all just generally professionals who are earning a ton of money. And the way to think about this is that the government's saying we're going to give very generous contribution amounts you can put in to a pension. And the reason why these are generous is because people often can't contribute a steady amount throughout their career. You'll have bumper years, you'll have bad years. But we do have some particularly high earners, and I wouldn't want, a footballer being able to kind of continuously throw in tons and tons of money, because it's a lot of tax relief to give them. And footballers actually have a much earlier pension age as well, which is another thing. There's a topic for another discussion. So what they do with the threshold is that they say, or the tapered annual allowance is, as the name suggests, if you have a certain income, you're going to taper, as in bring down the annual allowance. So basically stop you being able to get as much tax advantage from pensions. There are 2 tests when they do this. It's a bit faffy. I do it a lot with clients. So I'm going to give you a really high level overview of this, but please do seek advice if you're considering doing this kind of stuff, because this is kind of quite more complicated planning. You've got what's called threshold and adjusted income, and you have to pass both tests for your annual allowance to be tapered. Threshold is basically everything you've earned. There are a couple of pretty random exceptions, but I'm just going to, for the purposes of this podcast and overview, threshold is all your income. Now, what adjusted income is, this is all your income plus any employer contribution. And the reason why they've got these 2 tests is because it's to basically stop people gaming the system a little bit and putting their being able to throw a ton into the pension to get down the certain thresholds and adjusted income. It's not perfect, and you can do a lot of planning around this. But basically, if your earnings are above 200,000 and your earnings plus your pension are over 260, it can be worth being very mindful of if you're going to be impacted by the tapered annual allowance. What happens then is that anything above the 260,000, every £2 above the threshold, you lose £1 of annual allowance. And what that basically means is that if you earn over £360,000, your annual allowance gets brought down all the way down to the minimum under legislation, which is £10,000. So potentially, let's say you've had an incredible year and over 360,000, without good planning, you might have a minimum allowance of 10,000. There are some planning tricks that people like me use to try and get around it as much as possible. It really does depend on the scope of the earnings, but hopefully that's giving you a bit of an overview on a few things. So let's just do a bit of a recap there. We've talked about if you're making the contributions yourself, that you get marginal rate relief. What can you do? Well, you could always set aside a bit of your income for pension contributions. Think about how you can use them to reduce your tax bill. We talked a lot about the differences in tax treatment. So the fact that you're getting tax relief initially up front, and then you're going to potentially be at a lower marginal rate when you retire. You get a tax-free lump sum. It grows tax-free. We talked about if it's via a limited company, that it can potentially be entirely corporation tax deductible, that you can maybe even use your carry forward if you've been a member of a pension scheme previously. But we need to be careful about holding it exclusively. We need to make sure it's actually a legitimate business purpose. We talked about that if you're a higher earner, you can potentially, as in earning over 200,000, you need to be mindful of the taper if you're going to do a lot of pension planning. So this is an area to definitely get advice on if you're earning at that level, which probably segues me quite nicely into saying that if you are a creator who is 6 or 7 figures and you wanting to know how to become financially free, that is exactly what I do at Creator Finance. I'm running a wait list throughout all of 2026, and it is a fixed fee financial planning program which is designed to get you actually to the point where work becomes optional as quickly as possible. It's all well and good building this creative business, but if it doesn't ever materialize into something which is going to be substantial and is going to sustain you financially, then it could all be for nothing. And the job of Creator Finance is to make sure that you're using all the tax planning that's available to you, that I'm acting as your strategic thinking partner to navigate the maze of the UK tax position. Did you know, by the way, that the UK tax law is actually longer in length than the entire works of Shakespeare? So it's a hard thing to navigate. And unless sometimes you get the right advice, you're in a position where you're probably going to make some expensive mistakes. So if that is interesting, there's a wait list in the link below that you can join just to let me know that you're potentially interested in hearing more. Or alternatively, sign up for the lead magnet, which is the Creator Wealth Blueprint and £10,000 of tax saving tips with loads more gems like this. All right, back to the show. So we talked about a lot of people forgetting to claim higher rate tax relief, not using their carry forward because they weren't a member of the pension scheme. I think also as well that there can be, especially from what I've seen in entrepreneurs, there can be a bit of a trap in relation to waiting for stable income. Your income often varies hugely as an entrepreneur. And what I would say is that when we're looking at doing a pension strategy for clients, we don't want to go all in. We don't want them to be poor over the short to medium term so that they're wealthy in retirement. That makes no sense, and that's going to bring a load of anxiety. So what I'll often do is I'll ratchet up contributions as we go. As the business becomes more and more successful, we'll try and ratchet up as we go. So we'll start the habit, we'll get everything set up, we'll get the growth going, but we'll make sure that we get, did I whistle there? We'll make sure that we get the balance right between living for today and providing for tomorrow. So that was the Creator Finance topic. Hope you found that useful. So let's move on to wealth wisdom. So I want to talk about storytelling, why that's relevant for creators and digital entrepreneurs. And this is the best story that I've ever heard about storytelling. And it really resonates with me. And it's something that I try and remember on most of the time when I'm designing any content. And when I designed this podcast, if I'm being honest. And it's going to go back to a guy who I'm almost certain that you've never heard of. He's a guy called Edward Everett. We're talking about Civil War kind of time now. He was an American PhD, United States Congressman, governor of Massachusetts, president of Harvard University, one of the best universities in the world, Secretary of State, and he was even a vice presidential candidate. He was considered one of the best orators of all time. So people would literally travel for hours to hear him speak. He was able to hold conversation for several hours and had such skill and prose that people would travel to go see him. He had a huge magnetic presence. And it kind of makes you think that, well, why have we never heard of him? Now, if I was to add that, say that he made a Civil War speech that was on the most famous battleground in the entire American history, I would argue. And he did the keynote speech at that battleground. Now, there was a man who followed him, who was the president, and he wasn't even the keynote. So this kind of gives you a bit of a taste of how good a speaker he was. And his speech was different, completely different in structure, in length. And he came up to speak. And unlike Everett, who had spoken for hours, he then delivered what is arguably the single best known speech in American history. If you haven't guessed already, this was Gettysburg, this was Lincoln, and this was the Gettysburg Address. And he talked about the speech you might not know because we as Brits don't kind of have it drilled into us as much as Americans do, but it's the one which starts 77 years ago. Our fathers brought forth on this continent a new nation conceived in liberty and dedicated to the proposition that all men are created equal. It was done during the most bloody conflict on American soil, the Civil War. thousands, hundreds of thousands of people had died in horrific circumstances. The nation itself was, at the brink of breaking up. It was a huge point in American history. And this speech ended up being so powerful that to this day, it's often still recounted in primary schools, and they often say it in the morning, basically, along with the Pledge of Allegiance. How did that happen? How did someone who was, yes, the president, but would deliver a speech at a battleground that then was able to personify what it was to be American? The fact that this speech is remembered so clearly, that the end of the speech goes that we were highly resolved that the dead shall not die in vain, that this nation under God shall have a new birth of freedom, and that government of the people, by the people, for the people, shall not perish from the earth. And I think there were three things from this, which is why you have heard of the Lincoln speech, or you probably have, but you've never heard of Everett's name. I think first, it was the economy of words. Lincoln spoke for under 300 words. Everett spoke for hours. There was no single theme for Everett. There were lots of themes. But Lincoln spoke precisely. He knew exactly what he wanted to say. And while Everett had spent days preparing for this pivotal speech at Gettysburg, he hadn't really been able to summarize the whole purpose of why they were there or what he was speaking about. And I think the reason why this is relevant for creative digital entrepreneurs is that in this economy, in this attention economy, your ability to precisely explain your point, your message, is going to be more and more important. The second is that he understood the medium. So Lincoln's speech, the Gettysburg Address, was able then to be printed, and the following morning was out in newspapers across the nation. It was able to be read. The message was able to be spread. Unlike Everett's speech, which was impossible to recount, it was hours long. Whether Lincoln knew or not the power of the medium was the message here. It was able to connect people across time, but it wouldn't have ever landed as much if it wasn't for the fact that he'd been able to make it short enough to actually fit into newspapers and be something that was able to be printed. So he understood his medium of communication. And in today's environment where the social platforms, the communication methods, the way that we connect may change significantly in the next few years, it certainly has in the last 5 years, understanding your mediums of communication are key. And the final one, which is the one that I remember the most and I think is the most important, is Lincoln understood emotion. It wasn't just a message. It was effectively kind of the spirit of a nation. He managed to somehow personify in that short speech the whole purpose behind the Civil War, what they were fighting for, that the people had not died in vain. I think it's something that we lack here in the UK, that ability to rouse people, that ability to link values across time. And it's the fact that he was able to connect with people on this, which I believe made him a great leader and clearly a great orator. So that's my lesson on storytelling for you. It's about economy of words, about the medium. The medium is the message. And most of all, emotion is the key thing, the key currency for communication. Thanks so much for listening to Creative Finance. I really appreciate you being on this journey. I hope you continue to join me on it going forward. Thanks for watching.